Hello and welcome, everyone, to the Peregrine podcast. I'm Bill McIntosh, here in London with Peregrine Communications. Thanks for tuning in. In this edition, I'm thrilled to be joined by Will Wainewright, the founder of Alternative Fund Insight. Recently, Alternative Fund Insight, or AFI, launched the AFI 500, which is dedicated to tracking the world's 500 biggest hedge funds. Everyone in the hedge fund space and broader investment space knows Will for his distinguished years of reporting at HFM Week, Bloomberg, and EuroHedge, where he served as editor. Following that, Will founded AFI in 2022. Welcome, Will, and thanks very much for joining me.
Bill, it's great to be here. Thank you so much for the invitation.
No, completely our pleasure. Now, first off, please take us through what was in your thinking about setting up Alternative Fund Insight. There's obviously lots of information sources in the market. What did you hope that AFI would do better and perhaps different than some of the other services that are out there?
Yeah, well, AFI started as a podcast in the second half of 2022, interviewing hedge fund managers and allocators. And the aim was to really help members of the industry understand their thinking and navigate what can sometimes be quite an opaque world of alternative investments. So I think there is a real demand out there for real analysis, genuine insight and intelligence. And that's the spot that I want to occupy with AFI, in between the news outlets and the data providers, that central space where we can step back and look at the real deeper trends that are driving change in the industry. So I started the podcast, and then I took that ethos of kind of deeper insight into starting the platform at alternativefundinsight.com, focused on hedge funds and multi-managers, providing original research and analysis. And we've been putting out more and more research over the last few months.
Well, that's fantastic. It's obviously come a long way from the very first podcast, and you really established a nice niche there, bringing together authoritative data with some insightful analysis of that data. I mean, really, that's obviously what information content is all about. Now, with AFI having been established for almost 3 years, you've launched the AFI 500. What led you to set up such a comprehensive ranking tool for the hedge fund space, and what have people been responding to you having set it up?
Yeah, so the AFI 500 is a major research piece providing an overview of the global hedge fund industry, 500 top firms by strategy and region, and also it ranks them by gross assets, which we'll come to in a bit. So I've been tracking the space for quite a long time. I just know how much people like to know the lay of the land in this space in a single source, where it's one place they can look to and get a sense of the main strategies, the changes in terms of firms going up and down, and regional changes. And so it was a response to demand, really, that led me to put it together.
When you were setting up the AFI 500, what were some of the key challenges you faced in terms of getting the data and being able to categorize and organize it in the broad term, just getting it up and running?
Yeah, it was a lot of legwork, a lot of hours of research off the back of my network and my understanding of the industry. So just to step back, it's 500 firms broken down by strategy and region and searchable along those lines as well. And in terms of the asset ranking, there is a fountain of data out there in US regulatory filings, which once hedge funds get to a certain stage, a certain level of exposure, they've got to file with the US regulator. So that was how we got the kind of numeric side of things sorted. So yeah, it was a lot of work, but it's probably the piece of research that's got the biggest industry response so far. So it's definitely been worth doing.
No, most certainly. Now, within the rankings that you just brought out a little bit earlier this year, within the AFI 500, Millennium emerges as the biggest hedge fund, and then it's followed by Capula, Citadel, Cube Research and Technologies, and Symmetry Investments. I guess this might be surprising to some investors and listeners as well, I should add, given that Bridgewater is normally considered numero uno with AUM at the end of 2024 of about 174 billion. But you qualify this by noting that the ranking is based on so-called regulatory AUM disclosed to the regulator, which of course includes leverage. And I want you to explain this a bit more and tell us why you've chosen this methodology and how that's played out.
Well, you said it. I mean, leverage is the main factor. So when hedge fund managers make these regulatory disclosures, they include leverage or borrowing, which gives a sense of their kind of market impact. And that's, of course, what regulators are interested in when they're looking at things like systemic risk and looking at the key players in the space. So those big multi-manager firms like Millennium, Citadel, they use a lot of leverage, and that means that their figures are larger than what you would expect from their absolute asset figures. And the Millennium is just over 70 billion in absolute assets. And you're absolutely right. Bridgewater is the only hedge fund manager with more than $100 billion in hedge fund assets in absolute terms. So leverage had an impact at the other end of the scale with the smaller firms on the ranking and those that are based outside of the US. Not all of their hedge fund AUM will necessarily have to be captured by the US regulatory requirements. So it gives a great sense in terms of a guide to AUM and the size of the industry.
No, that's really interesting. I guess because it measures leverage, it's also measuring potential impact, both from the standpoint of long leverage and then short leverage as well. Turning now to the AFI 500 itself and how it breaks down by strategy, can you just walk us through some of the main buckets there and the number of firms in each one?
Yeah, absolutely. So long short equity, as listeners will know, is the biggest hedge fund strategy area. So 111 firms had a long short equity strategy. And then a further 56 firms had a equities strategy, which was long only or deep value. So with that, it's firms like TCI who have kind of moved away from short selling now. The second biggest was credit with 96 firms. So, equity and credit together is just over half of the list. And then we've got a mix of, the multi-strategies, macro, quant, event-driven is slightly lower down, all the way down to digital assets on 2 firms. So it's a nice spread and gives a sense of how different hedge fund industries place in the sector.
Yeah, it's interesting because I think credit has become a much bigger area for allocations by investors in recent years. And the fact that you've got about 1/5 of the firms in the AFI 500 in the credit bucket would obviously seem to underline that
Yeah.
growing demand for credit strategies among investors. Because I guess at the end of the day, if investors aren't going to allocate to a particular strategy, then by definition, the firms aren't going to be in the top ranking in something like the AFI
Yeah, no, great
500.
time for credit hedge funds, but you could honestly make an argument for so many of the strategies on this ranking. Hedge funds have been doing much better in the last few years.
Mhm.
And so much talk about the big multi-manager pod shops, which have performed very well. But last year as well, you saw a big renaissance in performance among long short equity.
Mhm.
Very excited about event driven. So I think it's quite an exciting time for hedge funds in general at the moment.
I think you're right. And I think the volatility, both emanating from the United States, but also some of the macro stuff in Eastern Europe and indeed in Southeast Asia, especially regarding China, where the sell-off of markets, especially equities, has been so pronounced. There's a lot of movement and a lot of potential to revert to the mean, both on the downside in North America, shall we say, and on the upside in other places, notably Southeast Asia, indeed, even in the UK itself.
Yeah, absolutely. I think that the higher rate environment has boosted hedge fund performance. So we've seen that over the last 3 or 4 years, say. Hedge fund performance tends to be stronger when interest rates are higher. But there are other factors here as well that are driving interest in the space. I think liquidity is now a massive priority for allocators in a way that it just
Mhm.
wasn't in the years after the 2008 crisis. And that was partly why private market strategies were so popular. But now I think liquid diversification is really important for allocators. And that's what hedge funds, or the majority of hedge funds, do offer.
Yeah. One thing that did catch my eye was that you distinguish between multi-asset, in which is 56 firms, so almost 10% of the survey, and so-called multi-strategy, 33, which is about 7% of the survey. And I just wondered from the standpoint of your methodology, how you distinguish between a multi-asset and a multi-strategy firm, just very generally.
Yeah, absolutely. So with multi-strategy, those are the firms that lead in terms of their product offering on multi-strategy. And the majority of those are the multi-managers, the pod
Mhm.
shops, those big firms that specialize in having lots of different approaches offered to allocators in a single product. Now, with multi-assets, you've also got quite a few firms who offer different products in different asset classes. They've got different teams doing it. and big distribution team that are offering those different products to different end investors. It's less about having a single multi-strategy product for those firms, even though more and more of them are thinking maybe we should offer some kind of product along those lines.
Yeah, no, and another thing that caught my eye was that the so-called multi-asset manager Aberdeen, Fowles now restored
Yeah,
as of just
absolutely.
last week. Hallelujah. Aberdeen features at number 8 in the top 10 of the biggest funds, and it's the only so-called traditional asset manager to rank so high. But I guess that's because in a previous life, Standard Life Investments had its Global Absolute Return Strategy, or GARS, which for many, many years managed billions of dollars. And although it's, I think, shrunk in size, there's obviously other products they've grown
Yeah.
to basically fill the space that GARS won't have. But just to move on to the next area, quant and managed futures funds, we've got about 10% of the funds, I think 48 in total in quant with 35 and managed futures with 13. And again, I was just going to ask you a little bit about how you differentiate between quant funds on the one hand and managed futures slash CTA firms on the other.
Yeah, I think with the quant firms, a major example there would be Two Sigma in New York.
Hmm.
And those are firms that are totally quant focused in everything they do across a range of different strategies. AQR Capital Management, Cliff Asness's firm, is another example. However, AQR also has CTA and managed futures within its offering, but it doesn't lead on that area. So those are the quant firms. And with CTA managed futures, those are firms like Winton, Aspect Capital, who are focused on that strategy in particular.
Now, I guess AHL would fall into that category as well.
Yeah, well, within part of larger Man Group, yes,
Yeah, that's right.
exactly.
And so with Man Group, but just as a segue here, Man Group is a firm, I guess, would it feature as a multi-asset firm?
Yeah, that's in the multi-assets category because they have such a broad range of individual products across equities and credit, quants, and discretionary.
Yes, they do. They certainly have a broad range of what they like to call investment engines. And of course, in recent years, they've started to build private markets engine in a way that should potentially pick up more speed as time passes.
Yeah,
Uh,
and that's just quickly, Bill. I mean,
yeah.
that's a big theme as well. Hedge funds that are doing more on the private side now. Balyasny is an example
Mhm.
of recent strategy development. So they are always innovating and thinking about what they can do with their strategies to capitalize on the market opportunity and also what allocators are looking for.
Yeah. Well, this goes back to your point we were discussing a few minutes ago, where we were discussing that because of the environment, there seems to be a large amount of opportunity, but it's also requiring increasing amounts of innovation, whether it's strategy or the use of technology slash AI, or indeed in tapping into new investor classes, like, for example, the increasing push to tap into so-called retail markets in the United States. All of these things are driving the expansion of the industry and working to, shall we say, put forward another almost, dare we say it, golden age of hedge funds, which may just
Who,
be around the corner.
who knows? Maybe too early to tell, but who knows? I think it is quite a bullish moment for hedge funds at the moment, for sure.
And it's interesting because one of the newer asset classes that's really only come into the hedge fund space in the last few years is so-called digital assets or crypto type investing. And in this survey, I think there's two firms that have made the AFI 500. And I just wondered if you were able to identify for us which firms they are, and then we'll come back to a second question I've got.
Yeah. Well, those firms, they are Polychain and Pantera.
Okay.
And to the point about that, with two firms, that is the smallest segment on the list. It's interesting to think about whether we're going to see an expansion there or whether the way that digital asset strategies really become more prominent in the world of hedge funds is via the established firms, macro, multi strategy operators who have been introducing these strategies and
Mhm.
offering them as kind of sleeves within products. Even Marshall Wace now is focused on it in part. So, yeah, I think you're going to see both established firms doing more there. Whether you're going to see two become 10 in the next few years, that just depends on allocator sentiment and whether the big institutions are really comfortable putting more and more money to work in the area. Quite possibly.
No, I think that's right. My guess is that it will continue to expand, that there's probably some firms that aren't very far outside of the 500 threshold that aren't there yet. So it's really a question of whether the market, in terms of the asset prices, continues this positive momentum. And then if that also helps to draw in allocator capital and thus expand both existing firms and launch new ones, not to mention the sleeves that you correctly mentioned, that the big macro or multi-strategy firms are increasingly offering to try to get investors who want exposure to that space to stick with the manager who they're probably already invested with in another area and thus
Yeah.
comfortable with the risk management and operational structures that those managers are using in other asset classes.
Yeah, absolutely. It's definitely going to continue to grow, that's for sure. I think the question is all about the volatility and where not only prices go, but also how different strategies adapt and whether they can offer the true risk adjusted returns that allocators are looking for.
Indeed. Well, as asset managers get bigger and bigger, they're able to devote more and more resources to sales and marketing, improving their technology and offer its operational differentiation, i.e., to guard their moats, as well as attracting, new investors to get bigger still. And I wonder with artificial intelligence and the DeFi revolution, whether there's potential challenge brewing that could see some of the giants eventually overthrown or at least challenged, shall we say, more concretely. Firms like Millennium and Citadel and Capula, they've been around for decades and they're likely to be around for decades more. But on the other hand, firms in this space have traditionally had a very poor track record of being able to move beyond the founder trader or the founding partners to
Yeah.
effectively pass the baton to a new generation. And I just wondered if you had any thoughts on what type of strategy or firm might eventually challenge today's leaders. And
Yeah.
if there was to be a revolution of this sort in the coming years, what this might lead the hedge fund sector to look like.
To your point about succession, which is a kind of perennial question in the hedge fund world, because so many of these successful firms have been built around founders, and those founders have so much control and sway. It's hard to see the business really kind of succeed long term after the founder retires. I think the answer there is about making those coming up through the business feel like they've got a stake in the future and can rise to leadership positions in the future. And you have seen some firms do that and kind of distribute equity throughout the business. And I think that the firms that have really not been able to grow and flourish over the last few years have been those where the economic interest was really held still at the top of the firm and others weren't incentivized lower down the firm. Now, on the question of moats, I mean, yes, the technology available is quite incredible now, and you are seeing lots of innovation and smaller firms try new things. I do think the bigger firms have an incredibly strong position now. They've got so much money, they are investing so much in technology and how to use AI. They are at the forefront of a lot of these trends now, which will help them protect their position. They also have the money to spend on the best talent as well, particularly the pod shops, where, as everyone knows, the trading salaries and bonuses have grown exponentially. So I think, to use a really terrible piece of jargon, there's bifurcation, where the biggest firms are really thriving and getting bigger. And then smaller firms at the lower end of the scale have been performing well and growing. And it's maybe a bit more difficult for those in the middle part of the industry. But, as I said before, I think it is a great time for single managers at the moment. Performance has been better. Fees they charge are not quite as divisive as pass through. So there's a good case to be made.
No, I think that's right. And I think you've hit on an important point there because I think that the larger firms, the Millenniums and the Citadels, and dare we say it, Man Groups and Capulas and Brevin Howards and a few others, they've got enough of a track record and enough of a following amongst investors built over many decades that unless they decide to shut down and return capital to shareholders, it should be possible for them to continue to grow and develop even once their founders, shall we say, are tending their estates in Tuscany or wherever they might happen to be. And perhaps the hedge fund industry has some lessons to learn from its peers in private equity who have, for the most part, had a better, I guess, track record taking firms public such as TPG and Apollo and Ares and a few others, and thus being able to transfer the equity to a new generation of partners and leaders, and thus have the firm succeed beyond, shall we say, the time frame of its founding members.
Yeah, I think that institutionalization is definitely right. And that's something where, although hedge funds are much more institutional in nature in terms of their infrastructure and operations now, you don't see too many publicly traded hedge funds still. And yeah, no, I think that's definitely right. Although if you said to Cliff Asness that the hedge fund industry could learn a few things from private equity, I don't think he'd be very happy.
No, but Cliff tends to be something of an iconoclast who has very personal and, shall we say, perceptive views about a lot of different specific situations. Okay, well, one last thing that I wanted to discuss today was that, and this is probably going to be, I think, a bit of new news, shall we say, for our audience, but many people listening won't realize or know that Will is also an accomplished author. He published a book a few years back entitled Reporting on Hitler, Rothley Reynolds and the British Press in Nazi Germany, and Rothley Reynolds and the British Press in Nazi Berlin. I'm not sure which. But it's basically a book that takes place, I think, in the 1920s and 30s and describes the adventures of a British writer, Rothley Reynolds, and what happened. Can you discuss that a bit with us?
Yeah, thanks, Bill. That's definitely a bit of a surprise. You've definitely done your research. So, Rothley Reynolds was actually a distant relative of mine who was born in 1872 and had a career in journalism, including writing for the Daily Mail in Berlin between the wars. He was one of the first foreign correspondents to interview Adolf Hitler
Wow.
early as 1923 and was in Berlin until the start of 1939 when it started getting quite hostile for foreign correspondents. So it was a family history project that I'd worked on for years together with my mother. And yeah, we just loved doing all the research into his life. And it then captured the attention of publishers when I kind of raised it with them and was released in 2017. Still available at all good bookshops, I might add. And maybe the research that went into reporting on Hitler laid the foundations for the research that went into the AFI 500.
Well, certainly that discipline would have helped guide the outcome of both projects, I would have thought.
Yeah, I think so. Yeah. Thank you for the invitation today, Bill. It's been great.
Good. Well, it's been a pleasure to have you, Will, and get some insights on, obviously, the AFI 500. Thanks so much for joining us. My guest has been Will Wainewright, the veteran hedge fund journalist and founder of Alternative Fund Insight, which recently published the authoritative survey of the sector, the AFI 500. This brings to a close a truly fascinating and hugely insightful edition of the Peregrine podcast. Thanks very much for listening.